Okay, so welcome everybody to this pension information presentation. So just first and foremost, I'd like to welcome everyone along today, and I hope they find it informative. And thank you very much to everybody who facilitated us in getting the email sent around, and for everybody who helped on that regard. So what I'll do normally, and you can tell me if it makes sense, is that what we do is we do the presentation, but then towards the end, if anybody has any questions, I can open it out to the floor. And it may be a case you might want to ask something on more an individual basis. Well, then there's financial planning consultations on offer after the talk today, but we'll also be in contact with everybody that's registered to do what we call the screening call, or a 5 minute call that basically get to answer any questions that you may have that you may not feel comfortable with asking here. So look, just to introduce myself. So my name is Neil White. I'm a certified financial planner with Irish Pensions and Finance, and I've been with IPF since 2014. So I suppose what I do is I sit down with existing clients, but also people that aren't existing clients, maybe that need to feel the need to get a better understanding of their finances. And I would say 99% of the people I sit down with are public sector employees. So the company that I'm with, some of you may be familiar with them, some of you may be already existing clients, is Irish Pensions and Finance. So who Irish Pensions and Finance, or who are Irish Pensions and Finance? So we're an Irish-owned brokerage, and we would administer payroll-deducted AVC schemes, or additional voluntary contribution schemes, across the public sector. So IPF have been in business since 1993. So that alone shows the longevity we have in the industry, but also the trust that's there between us and the public sector to provide really, really high level financial planning advice to people that are working in the public sector. So we have over 28,000 clients with us on the books at the moment, and we manage over €1 billion in pensions investments for public sector staff. Okay, so IPF, as I say, we administer those schemes, the payroll deducted AVC schemes. But on the right hand side, there is some reviews that I think really shows the level of service we provide to our clients. And there's none there for me, unfortunately, but there's just a sample of a few. So look, the purpose of today. So what do we want everybody to come away from today with? Is basically a better understanding of what main scheme benefits I'll receive at retirement. Now, some people might be thinking, what in God's name is he talking about when he says main scheme benefits? What they are when you see the lovely deductions coming out of the right-hand side of your payslip, and it says pension maybe 365 or single service scheme. When you're joined the public sector, you're automatically entered into the pension scheme. And with the pension scheme comes a pension, but other benefits as well that you pay for approximately 5% from your salary. So what today is, and what financial planning is basically protecting us in the event when we get to retirement, to make sure we have enough money, to make sure there's benefits there if we were to get sick or pass away, and then obviously how we manage our savings. And your employer's scheme will provide you a certain level of benefits in those areas. But our job and our expertise is that we sit down and we make sure you understand exactly what you already have before you start to build a financial plan on top of that really, really strong bedrock that's already there. And my motto will be, if it's not broken, don't fix it. So take a look and see what you have first, and then understand if you need to take action. So ABCs, additional voluntary contributions, that's, I suppose, our main contact with people in the public sector, and probably the most popular thing that we do with people. So is it something that may be of benefit to you, and why might it be of benefit to you? Then on top of that, and as I kind of put the cart before the horse a bit there, I said, look, what is the financial planning process? Like, what entails putting financial financial plan in place? And I suppose the way we work in IPF is that we always put a financial plan in place as opposed to selling policies. We're not transactional in that sense. We sit down and we do a financial planning consultation, and then make a recommendation based on what you want to see happen. And obviously then we understand and know how your main scheme works already. So we won't overly, I suppose, advise on something that you already have and you're already happy with, which can be the case. So next is, why do public sector staff meet with us? So why would, let's say, a nurse, or let's say a clerical officer, an executive officer, or a guard, a physiotherapist, an accountant, a forensic scientist, why do they sit down with us? And some of the reasons are that they started working later. So they may have worked in outside the public sector. They might have qualified a little bit later, or they might have worked in private industry. So they're joining the public sector later, which means the benefits that they have are going to be less, because how the benefits in the public sector work are that they're based on your salary and then your service. So the more years you do, the more benefits you're going to get, or the higher level of benefits you're going to get, I should say. You might have spent some time working abroad training, or you mightn't have been located in Ireland and have just moved. Then you want to understand, well, look, what do I have now that I'm in Ireland? Job sharing, reduced hours. So, for example, you may work a reduced working pattern. Like, what impact will that have on your retirement as a result of that? Or what impact would that have if you were to have to take time off work due to an illness or an injury? Career breaks. So you talk about, let's say for argument's sake, 2 years off to take care of children, for example, or you wanted to go to study, or, there's various different reasons for career breaks. But what impact will that have on your pension? Non-pensionable employment. So, for example, the job that you have might have additional income available through overtime, but that doesn't actually form part of your core pension benefits then when you get to retirement. So how do you counteract that issue? The next one is I'd like to retire early. So if I had €1 for every time when I sit down with someone and I say, well, look, do you have an idea of when you'd like to retire? And they tell me tomorrow, I'd probably already retired 2 times over, I'd say, because people like the idea of retiring early. But, it can oftentimes be a passing thing. I'd love to be able to retire early. Well, look, sit down, take a look and see, well, look, if you did retire early, what do you already have being paid to you from your employer? And then on top of that, what would you need to do to actually make that a reality? So I sat down with a client only 2 weeks ago. We looked at where they were for retirement. They said, look, I'd love to be able to get out the door at 60. And they were a physiotherapist. And we looked at it, and due to the nature of the role that they're in, they felt, look, can't see myself doing this past 60. Look, what's my pension at 60? And we looked at it, and the pension from their employer was going to be about €350 a week, give or take. And they said to me, look, that would be tight based on my lifestyle that I have now, but I could make sacrifices. I said, well, look, if there was a way that you could have the income that you'd like to have, which was, I think, about €700, and you could retire with that and you wouldn't have to make those changes to your lifestyle, is that something you'd like to be able to start planning for now if you could? And when we looked at it and they had about 20 years to go to retirement, they were able to make additional contributions to a plan that actually made that a reality. And now they're paying on a regular basis into something that they know if they want to go at 60, they're not going to have to make massive lifestyle changes, or they're not going to be forced to stay working longer than they want to, because they put a plan in place and they review that plan now every year moving forward to make sure it's still what they want and what they're putting themselves on track for. The pension gap. So, for example, if they retire at 60 and there might be a transitional pension at play, how do they bridge that gap between 60 and getting the state pension at 66, for example? And the next one would be post 2013 members. What does that mean to be a post 2013 member compared to, let's say, for example, their colleagues who joined before 2013? And what kind of pitfalls, from our experience in IPF, are we able to help you steer and navigate against? Significant life event is a big one as well. So what that means is that I sat down with another client. He was a guard, sat down with him and we had a look at his pension and his lump sum. All he wanted to do was top up his pension a little bit. He was single, was renting, no kids, and was in a different circumstances to 3 years later when I sat down with him, and he had bought a home. He's now a sergeant. He's gotten married and he has kids. That's, life events happen, and therefore those life events require adjustment to your financial plan. And that's what we do as financial planners, is help you or advise you on what changes you should make to achieve the objectives that you have to look after the most important people to you, which will always be your family and your children and your dependents, and obviously yourself then as well. So if another big one then is the effect of inflation on savings and investments. So we oftentimes sit down with people who, may be lucky enough to either have savings set aside that they want to make sure is working hard for them, that they don't see themselves needing in the next 5 years, or they have I suppose coming down the line, they're going to have two kids in college at the same time, for example. There's going to be a bit of crossover, and they need to start offsetting some money now for that time, so that when it does come that they have two kids in college with fees, or if one goes to study away or abroad, they have money there set aside to support them. And oftentimes saving into the likes of the credit union for those kind of things don't make sense, because you're not getting any interest or any return for it, and you're doing all the heavy lifting, when in reality you should be getting the market and saving and investments plans to do some of that heavy lifting for you. So if anything jumped out at you before we kind of get into the weeds a little bit about how your main scheme pension works, if any of that straight away you're thinking, look, he has just said something that's been on my mind for the last little while that I need to look at, that there is our QR code. And the tech savvy that we are, you should hover the camera over, and that'll take you through to what we would refer to as our pre-appointment questionnaire, where you can actually fill in your details now to be able to arrange to get a call back from myself or my colleague to book in to have a conversation, that 5 minute talk about what may be your concern and whether or not availing of the complimentary financial planning consultations that we offer are something that you'd like to look at. So we're going to contact everyone that are registered for the presentation, of course, but if you want to jump ahead of the queue, that's how you do so. So we know that you do want to call, but that's going to be in the top right hand corner, as we can see there. So if it pops up again at any point during the presentation, you can scan it. Okay, so superannuation scheme. What language am I speaking here? So superannuation scheme is basically your main scheme pension, but the other benefits, like if you were to get sick or pass away, are included in that. And everybody that's on the call now, because if we're all public sector employees, or if you are all public sector employees, I should say, you have five main benefits as part of your superannuation scheme, right? And single service scheme. So it's pension, lump sum, sick pay, death and service, and spouse and children's. So five main benefits. Now, what impacts on those benefits, right, or how to decide what kind of benefits you get, are going to be based firstly on when you joined. So how they formulate or calculate what benefits are going to be given to you is based on when you joined. Then they take into account your salary, and they take into account your service. So those three are the three kind of areas that when I talk to you, I'm going to want to find out about you, and want to find out before I'm able then to put forward what actually benefits you have from your employer. And then we can start to see and stress test whether or not what's already there is going to be sufficient. So I suppose that's where we come in. That's where we've been doing our training and our experience for the last 30 odd years as a company, and mine in the last 11 years will be able to help you put a really robust financial plan in place based on that. Now, the pension is your regular income when you come to retirement. You get a once-off lump sum in retirement, but then if anything was to happen to you between now and you get to retirement, you typically have 3 months full pay, 3 months half pay. But after that point, you go on to about €200 or so in state ill health benefit, which, again, maybe if you're younger and you're thinking, well, look, if I do get sick, it might be something that keeps me out for a week or a month at most. But as we get older and as we start to realize that I've had two kids now, and I have a mortgage, and I'm a little bit more in that risk period of my life now, in my 40s to 50s and early, at that point, that if I do get sick, it's going to be in and around this age demographic. Well, then you may need to look at the likes of income protection, which basically will ensure that if you do have to take off a prolonged period of time from work, you actually have a replacement income coming into the household. So income protection is an extremely, extremely important plan to consider based on your circumstances. And if you do meet the criteria that it does make sense, and you can't get it because it is a difficult policy to get, I would always say, look, it is something you should put in place along with your other parts of your financial plan. Debt and service means basically there's a lump sum payable to your next of kin if you're to pass away while you're in service. So why is that important? Well, if the loss of an income to the household was to occur, what sacrifices are going to have to be made in the future to replace that loss of income? Is plans around education of children going to have to change? No one knows how they'll deal with a death within the household. The individual, that the surviving spouse, may not be able to go back to work straight away. That could put a financial strain on mortgages if there's no, sufficient level of cover in place there. So always review that and always make sure it's enough. where at all that you can. And then there's a spouse and children's benefit. So there is a part of your pension paid into the household. So what we always help our clients do is understand that part of it as well, so that they don't end up putting too much cover in place as well. Because at the end of the day, it's an insurance policy and we're paying for something we hope never happens. So just as much as it's important to pay for some level of cover, it's always imperatively important not to pay for too much. Okay. Um, so the main focus is today, right? And I kind of spoke about the other parts of the consultation process, like the likes of income protection, the likes of life cover. We work in a multi-call process in IPF in the sense that when we speak with you on the phone, typically what we'll do first and foremost is stress test and look at your pension and see the most likely thing to happen everybody on this call is not that you get sick or not that you pass away, is that you get to retirement in really, really good health, which is great news. Now, what is also likely to happen is that you may get closer to retirement not really knowing what kind of income you're going to have. So let's plan for something we know is definitely going to happen. And then we can start to look and stress test the things that we hope don't happen. So what that is you're going to be entitled to a pension when you come to retirement, which is a regular income, which basically replaces your earned income that you had while you were working, right? So in this example here, right, so there's four cohorts, or sorry, three in a way cohorts of the public sector pension scheme, right? And there again, like I mentioned previously about entrance, so when you joined. So the first one would be for people who joined before April 1995. The next would be for people who joined between 1995 and 2013. And the next group of people are the people who joined post 2013. Okay. So if we take, for example, the first cohort, which is the pre-1995 entrants, which is the old pension scheme in a sense in the public sector, their pension, how it's calculated, like bringing it back again, is when you joined, your salary and your service. So in this example, everybody has the same salary and everybody has the same service, but everybody has a different entrant date in these three characteristics. So as we can see here, we got this individual here. Sorry now. That's joined here. They've joined pre-1990. Sorry, I've clicked on there mistakenly. So they joined before 1995 and they have 40 years service is the full service. Their pension is going to be 25,000. Simple enough calculation. It's 50% of what your pension or your salary was. If you, let's say, for example, had 20 years of service, well, then their pension is going to be 12,500. So the more years you work, the more pension you get. If, for example, you had an individual that worked for 40 years but job shared, then that's 20 full years completed because it's a 50% pattern. So therefore, it's 12,500 again. So in this example, there's no state pension payable. All the pension is coming from the public sector. So just to bear that in mind. The next group of people are anyone that joined between 1995 and 2013. Now, their salary is the same, 50,000, service is the same, and you might be thinking, well, why are they only getting 11,200 euros as opposed to the 25 that the previous colleague was getting? That's not fair. Very fair point, makes sense. Well, the reason for that is that they have an entitlement to a state pension now, and they would refer to anyone who joined after 1995 up to 2013 is on an integrated pension scheme. So what that means is that the state pension, which is about 13,800, brings them up on their pension. So it brings them from what they were on here up to what the 25,000. So that's the state pension. I'm not even going to attempt to try and write state pension there, but that's what it would be. Okay, so it brings them up to the pension they would have been on, on the previous to cover that there. So they're on the same level playing field. Now, the next group of people are anyone that joined after 2013. Now, the same final salary is the same and the same final service is the same, but the pension is now only 7,500. And you might be thinking, well, what? Like I understand the state pension is going to add on to that. So that's going to be about, as we mentioned previously, about 13,800. But that's still only going to bring them up, to a good chunk below where they were, about 5 grand below. Like, where is that coming from? Like, why is that happening? The reason for that is that the pension post 2013 is career averaged. So even if their salary may have been finishing at 50,000. They may have started on a 23 or 25,000 and finished on 50. So their pension is actually going to be based on an average of their salaries over their career as opposed to a final. So all that means, and all these figures I'm saying now, don't mean much to the individuals that are on the call today. So what happens from today is really speaking to one of our financial advisors who will say, when did you join? When would you like to retire? What's your salary? And what your, we'll work out what your service will be. And they'll be able to say to you, well, look, based on as you're going at the minute, you're going to be on track for 200 euros or 500 euros a week or whatever the figure it might be. Do you feel that based on what your lifestyle is like now and what you'd like to be able to do in retirement, and also your household circumstances, like are you the only pension in the household? Will two of you be living on it? Is that sufficient? And if it's not, that's when you start to put your plan in place, as opposed to sitting down saying, I'd like to put a top-up pension in place without really knowing what's underneath, what you already have there from the employer. So the next part of your pension is that you get a lump sum. So what happens is you get a tax-free gratuity from your employer. And the tax-free gratuity is once off, and it's again based on salary and service. So the more you work, the more years you work, the more lump sum you get. So if you retire with a salary of 50,000 and you joined pre-2013, so the lump sum is calculated the same for every entrant, pre-95 and pre-2013, everyone up to that point, they get, with full service 40 years, 1.5 times their final salary as a lump sum. If they don't work the full 40 years, only 20, then it's pro rata reduced. Now, the reason the post-2013 entrance is less is the fact that their lump sum is based on a career average as well. So they're going to be impacted there on having a less lump sum because of the fact that their pension and lump sum are based on a career average salary as opposed to the final salary, okay? So they're all things, again, to bear in mind when you're speaking with the financial planner. Now, the next question we oftentimes get, and I'm conscious of time, so I may just move things on a little bit, is the what do I need to live on question. Oftentimes people say, well, look, what do most normal people live on, or what do other people live on? Everybody is very different, and I've been doing this job for 11 years, so I've met thousands of people over that period of time, and everybody is very, very different. I can say that for sure. But to give you a feeling for it, what I would always say to clients, right? This is an example of what average, now it's based on CSO figures, of what the average outgoings would be for one individual over a year, just to basically, relatively speaking, the bare minimum. What that allows you to realize that all these things are going to still happen even when you're retired. So I wouldn't, maybe this is going to be individual on the right hand side. So this will be very much individual here, right, as to what you actually spend. So that's going to vary. But you can be sure as anything that these are all going to be things that everybody is going to have when they come to retirement. Everybody still needs to eat. Everyone's still going to have bills. You're still going to have to pay some level of insurances. You're still going to have to pay for transport. Your house still needs to going to have improvements every now and again. You're still going to want to do some entertainment. You might want to travel as well. So they're all still going to be the same thing. And my own experience of my own father retiring was that when he retired on the Friday, and on the Monday when he woke up, then again after being retired, he wasn't a completely different person. He was the exact same person he was on the Friday when he was still working technically to when on the Monday, but he still liked the same things, still had the same hobby, still wanted to travel, but he had a hell of a lot more time in his hands. So what he always wanted to try to do was to be as financially secure as he possibly could, so that when he came to retirement, again, like I say, you don't have to start making massive lifestyle changes, just because you're retired. It should be a time, and it is now a time with life expectancies and, people's quality of life, that they're actually able to really save and put a plan in place to really enjoy it. So one of the ways that you can do that and help to do that is through the Additional Voluntary Contribution Scheme, or the AVCs. So the AVCs, what they are a tax efficient means to save an additional pot of money in retirement to be able to supplement the regular pension that you have from your employer. So how they work is you get tax relief through your salary. you can make regular contributions or you can make lump sum contributions, but oftentimes people will do regular contributions through your payslip. There's charges on the ABCs, but they're built into the contribution that you make. So when we sit down with an individual, we don't charge a consultation fee. How we will work is that if you set up an ABC policy, you have a lower allocation into the plan in the first year. So effectively what happens is you pay for the setup of your plan out of money you would have paid in tax, in effect, right? How does the tax relief work? So for every €100 you save in an ABC, it turns into 167 in effect because of tax relief. So when you sit down and you look at the idea that I'd love to be able to retire at 60 with €500 a week as an income, I'm getting to 250 from the employer. What's going to make up that other €250 is going to be your contribution, your savings, money that you would have paid in tax when you were working, and then any growth between now and when you retire is free of dirt. So that is where the idea that smaller and sooner is going to be a lot more effective than leaving it to be larger and later. So this is an example of an individual who was to save €5,000 into an ABC through the course of a year. Now you might be thinking to yourself, well, €5,000 into a pension plan. This is an example, by the way. Like, how can anyone afford to do that? Well, that actually, when you break it down to a weekly basis, is approximately €90 a week going into the plan, but the cost to the individual is €50 a week because of tax relief. So they do that over that period of time. And starting at age 30, they'll have a pot of €480,000. If they wait until they're 40 to do the same saving of €5,000 a year, they'll have 255,000. The reason for that is that they're losing out on what's called compound interest and obviously their initial investment as well. They leave it till 50, then obviously it's less time to build a return of interest, and then leaving to 60, very little, if any, time to build anything of note. So everybody is different and what everyone can afford to do is different. So when it comes to ABCs, there's two people who dictate how much you can have in an ABC. It's revenue and yourself. So revenue will set you a limit as to what the most you can do is, and then it's for you to decide how much you feel is affordable for you to do, or maybe how much you need to do to get to the objective that you have. Okay, they're adjustable, so you can increase them or decrease them. You can take breaks and pauses as well. So they're extremely flexible to the needs that you have. So what happens next? Look, around the financial planning process. When we sit down with individuals, we take a look at their pension. That's the first thing we look at, and we stress test that, and we help and put a plan in place where it's needed. Then we'll have a chat with you around other insurances, like if you're to get sick or to pass away, do you feel what's already there from the employer is enough, or do you feel you need to supplement them somewhat through additional plans or policies? We talk about saving. We help you understand, well, look, if you're saving something, is that the right place to be saving? Or then if you're investing, so you maybe received some type of an inheritance, or you had money built up on the credit union for some years of really effective saving, is the credit union still the most effective place for it? You shouldn't really have anything more than 3 months of net income in your kind of rainy day fund, as they'd say, which you could drop your hat on. The rest and anything else should be in something that is gaining an interest or a return. So why is financial planning important, and why is it something that it's important to show that we all should be speaking about? Is that it'll avoid, or if you talk about it and you engage in a financial planning review, it'll avoid common pitfalls like falling into debt, having a lack of saving, not understanding how much you should have in an emergency fund. It'll help you achieve milestones in a more efficient manner. First milestone for a lot of people is purchasing a home, then it's educating children, and then the next one is obviously around retirement. Give you a peace of mind. So during life events that give you uncertainty, knowing that you have a financial plan in place, we don't need to spend all our time thinking about the worst things that can happen, but bad things can happen. So you may need to take that hour once a year just to stress test and make sure the plan you have in place for things that we may not want to happen is strong. And then wealth creation, so helping you build a stronger future for yourself and your family. So look, what do we learn from today? So the main scheme benefits, I hope we have a better understanding of what they are. I hope maybe you have a better understanding of what ABCs are and how they work. And then lastly, around the financial planning process and how that works. So, what it entails engaging in the multi-call process with IPF, take that 5-minute screening call with one of our advisors, have a chat to them and see if the financial planning consultation is a benefit to you. So you could sit down and do the financial planning consultation, which are complimentary, of course, and identify you don't need to do an ABC or you don't need additional life cover, but it's much better off to know than not to know. IPF, we do mortgages. Okay, so if you're currently paying a mortgage, and you're unsure of the interest rate that you're on, I'd advise you to check that and make sure you haven't lapsed over onto a variable rate. Or if you're about to come off a fixed interest rate, I'd advise you maybe to speak to our mortgage manager, Ryan, who'll be able to advise you on, does it make sense to stay with the particular provider you're with, or does it make sense to maybe try and switch? Because there can be better deals out there if you're keeping an eye on it. We look at a lot of bills ourselves. I know electricity, phone bills, Sky, all that kind of stuff. We review and make sure we're not paying too much. But the thing that could really save us the most money in our lives, our mortgage, sometimes people are that bit reluctant to review. And you might hear people say, well, look, 3.5, what's that over there? And the other company 3. Sure, what difference does that make to me? Well, the difference is very clear there. You'll save 68 euros, I should say, a month, which is 816 euros annually, which about 25,000 euros less. Okay, but if you put that into your pension, you turn that 68 with tax relief into 103 euros, and then over the same 30 years of your mortgage, it turns into 100,000 euros extra in your pension fund. So again, with these financial planning methods and things like that, there is options and means by which you can save money or maybe redirect money into where you need to or get a better benefit of it. So look, what happens from today, as I mentioned previously, with this 5-minute screening call, we'll contact everyone that's on the presentation today and have a chat to them and then see whether or not it makes sense to avail of the complimentary financial planning review, where you can look closer at ABCs and then pensions, or ABCs or income protection or life cover and things like that. So look, I ran a little bit over than I had expected to. But look, firstly, just thank you very much for everyone for your time today.